For decades, real estate investors have leaned on one simple rule of thumb to spot a great deal. But in the market we're in today, is that old shortcut still a reliable guide? Or could it actually be a trap? Okay, let's dive into the famous 1% rule and really see if it still holds up.
Yeah, that's the big question we're tackling today. We're going to break down where this rule came from, why it was so darn effective for so long, and explore the powerful economic forces that are putting it to the test right now. So, to really get a handle on where we are now, we've got to look back at where this all started. For years and years, the 1% rule was pretty much an investor's best friend. It was this simple, almost elegant way to quickly sort the potential winners from the definite losers.
So what exactly is it? Well, the rule is what's called a heuristic, which, is really just a fancy way of saying a mental shortcut. It's a super fast way to guesstimate if a property is likely to have positive cash flow right from the get-go.
And the math behind it, honestly, it's about as simple as it gets. You just take the purchase price, add in any money you need to spend on immediate repairs, and your goal for the monthly rent is 1% of that total number. That's it.
Let's put some real numbers on this. Imagine you find a place for $300,000, and you figure it needs about $50,000 in work. Okay, so your all-in cost is $350,000. To meet the 1% rule, that property needs to be able to rent for at least $3,500 a month. If the market rent is only, say, $2,500, the rule gives you a very clear signal. Nope, walk away. This isn't the one. And I love this quote because it perfectly captures the rule's true purpose. See, the 1% rule was never meant to be the final word on a deal. Think of it like a first date. It's just a quick screen to see if there's enough potential there to justify the time and effort of a full analysis before you commit to a marriage.
Now, here's something really interesting. The 1% rule wasn't a lone wolf. It was actually part of a whole family of rules, a bigger toolkit of shortcuts that investors use to quickly check a property's financial health from a few different angles.
And as you can see here, each rule really has its own job. The 1% rule, like we've said, is for that initial cash flow check. The 2% rule, which, you almost never see anymore, was for finding those high-risk, high-reward deals. And then there's the 50% rule, which is a crucial reality check. It's there to remind you that about half of your rental income is probably going to get eaten up by costs other than your mortgage. But this is where our story takes a dramatic turn. The entire economic landscape has shifted so much that these old rules, they just don't apply like they used to. The simple math that worked for a decade has been completely thrown out the window. Just look at this. This chart gets right to the heart of the problem. On the exact same $400,000 loan, jumping from a 3.5% interest rate to a 7.5% rate increases the monthly mortgage payment by nearly $1,000. $1,000! That single change can completely wipe out your profit and turn a great-looking 1% deal negative overnight. And because of this, the market has had to adapt. With prices and interest rates both being so high, finding a true 1% deal has become incredibly difficult in a lot of places. So, smart investors have shifted the goalposts. Many now consider a 0.8% rule to be a much more realistic starting point in today's competitive markets. This brings us to what might be the most critical idea of all. Context is everything. Applying the 1% rule, or any rule really, blindly across all markets and all property types is just a recipe for disaster. You absolutely have to know where and what you're buying. So think of properties as having grades, like in school, from A down to D. A Class A property, that's your newer building, best part of town. It probably won't meet the 1% rule, but that's okay, because investors are betting on appreciation, the value going up over time. The 1% rule really shines with Class B and C properties, because that's where you find that healthier mix of monthly cash flow and still some potential for appreciation.
And your strategy changes dramatically depending on the city. In these high-growth markets like in Austin or a Phoenix, investors are totally fine with lower initial cash flow because they are banking on that long-term appreciation. But then you look at classic cash flow markets like Cleveland or Memphis, and yeah, the 1% rule is still very much alive and kicking, delivering strong monthly income right from day one.
So, if the 1% rule is just the first date, what metrics do the professionals use to decide if they're ready for marriage? Well, they use a more sophisticated set of tools that really tells the full story of an investment's potential.
First up is cash-on-cash return. This metric is huge, absolutely huge, because it answers a very simple, very important question. How much profit am I making on the actual cash I pulled out of my pocket to buy this thing? It's a powerful, pure measure of your investment's immediate return. Now, for the long-term thinkers, there's the internal rate of return, or IRR. Think of this one as a financial crystal ball. It helps you project your total return over the entire time you plan to own the property, factoring in everything: rent growth, appreciation, the whole shebang. It's absolutely essential for those appreciation-focused strategies we were just talking about.
And finally, there's return on equity, or ROE. See, as you pay down your mortgage and the property's value goes up, you're building up this trapped wealth called equity. ROE tells you how hard that trapped wealth is actually working for you. If that number gets too low, it might be a huge sign that it's time to sell or refinance and put that money to better use somewhere else.
Okay, so let's put it all together. What does this all mean for you, an investor trying to make smart moves today? It means you have to evolve. You have to move on from relying on a single, simple rule and start using a more dynamic, modern framework for looking at deals.
Here's the new playbook. 1. Use the right shortcut for the right market. Maybe that's 0.8% in a growth city, but you're still aiming for 1% in a cash flow town. 2. Do the deep dive. Run the numbers using metrics like cash on cash, IRR, and ROE. 3. Compare your deals based on their risk profile. And 4. Always have a plan for your financing down the road.
And that last point leads to this key strategy we're seeing a lot of right now. It's this idea of buy now, refinance later. Investors are buying properties that might have pretty tight cash flow today, but they have a plan. They lock in the asset, let it appreciate, and wait for interest rates to eventually drop. When they do, they can refinance, and that move can create a huge boost in their monthly cash flow. This quote just sums it all up perfectly, doesn't it? Heuristics are a starting point, not a final destination. The 1% rule isn't dead, but its role has changed. Success today is all about weaving together the simplicity of that old rule of thumb with the power of a deep, complex financial analysis.
The world of real estate investing is definitely more complex than it used to be. But you know what? It's also overflowing with opportunity for those who are willing to adapt. The question now isn't about whether a property meets an old rule. The real question is, are you ready to play by the new rules?